I'm Tom Selzer from Livewire Markets, and joining me today is Patrick William from Rixon Capital to offer his unique perspective on private credit markets. Patrick, thanks for joining us.
Thanks, Tom.
What's your view of the current outlook for private credit markets right now?
If I could encapsulate in one word, it's growth. The market here is still relatively nascent relative to the US market. The banks are continuing to withdraw from anything that's not large or vanilla. So we're seeing lots and lots of growth and lots of demand for private credit in the market. But what's interesting is you're seeing a lot of that private capital looking for private credit congregating in the property space. So we're a SME lender, and my messaging to investors is when you've got a scarcity of capital in a space, that's when you can generate those outsized returns. Whereas the property space, you're seeing fair returns for fair risk.
And why would you say we're seeing so much growth in property funds at the moment?
Probably two things. One, from the investor side, this is Australia. People love their property. People are familiar with property, and people understand property. And on the fund manager side, it's a lot more scalable and vanilla to underwrite. So, if you're doing a property development or even a brownfields property, you get a third-party valuation report, you make sure the documents are in place, you can deploy $50 million. Whereas with a corporate or SME strategy, there's a lot of detailed diligence in assessing and interrogating revenue models and asset bases.
And maybe moving away from property, we've also seen a rise in funds offering just asset-backed lending in general. What do you think investors should be aware of there?
Yeah, that's a very good point. So it's actually a very topical point. If you ask ASIC would agree. What is an asset is the first question you should ask. So there's a lot of funds saying they're asset-backed lenders for marketing purposes. But philosophically, if you're an investor, the purpose of an asset-backed fund management strategy is downside protection. So the key question they should always ask is, what is the asset? Does the asset retain value if things go bad? And can the asset be monetized? So the two examples I'd give is, say, a piece of equipment that's leased. The borrower becomes challenged. Odds are you can sell that piece of equipment for close to par and you get it done in 3 to 6 months. You'll get your money back. But then you look at the other end of the spectrum, a property development site. You've got a loan at a very attractive 60% LVR on an as-if complete basis. But what that means is when the project is complete in 3 years, you're at 60% of the value. What happens if things go wrong in year one? You've got a big fat loan and a hole in the ground with 3 pylons sticking out of it. So it's very important to understand what that underlying asset is.
How do you guys assess potential borrowers at Rixon?
So we've got 2 pillars in our strategy: capital protection and a very attractive monthly cash yield. So stage one, when a potential borrower comes to us, is we dive into their collateral base. What assets can you offer me? Are they tangible? Do they retain value? Are they monetizable? Are they overly specialized? Because they are, you can't get your money back. So if those boxes are ticked, we get an independent third-party valuer to come in. If it's equipment, tick, we know that we've got an asset base. Then we've got to ensure the borrower can actually pay our interest in cash every month. So the team spent a lot of time interrogating the revenue model. What are the contracts like? Is it recurring revenue? Is it contracted revenue? Better still, is it in a cyclical space or is it acyclical? So we want a business where we know that in times are good, they do well, but when times are bad, they do okay. That gives us comfort. That check turns up every month to service interest. And the thing about debt is it's very easy to put money out. The skill is getting it back. So if you do a relatively boring business, odds are you'll get your money back because there'll be someone there to take them out.
And moving to your fund for a moment, Rixon has 2 funds, Rixon Income Fund and the Credit Opportunities Fund. Do you mind just giving us an overview of the investing strategy behind those?
Yeah. So the philosophy of both funds is tapping an underbanked niche. So we focus on loans of up to $20 million. So the theory being, because it's underbanked, you're always going to get a supernormal return for a fixed level of risk. So the flagship fund is the Rixon Income Fund. I describe it as being the bottom left-hand side corner of the risk-return spectrum. All loans, first ranking, senior secured, tangible asset backed, very healthily cash interest payment every month. Target return 10 to 12%. The Rixon Credit Opportunities Fund is an inch up and an inch left. So a slightly higher risk, but again, for a materially improved return profile. So that fund will do first ranking on high quality cash flows. So no assets, but very high quality cash flows. Or second ranking, probably behind a bank where there are tangible assets. So it's not materially higher risk, but it is higher risk than the income fund. But the target returns there are close to 15%.
And finally, one recent development has been the rise of debt secondaries funds. What's your view on those?
Yeah, I've got firm opinions on those debt secondary funds. So the fairest way to say it is, you've got to judge any investment on its merits. You look at the risk-reward proposition relative to other options available to you in your market. So if you look at the Australian market, because it's still so nascent, even the property space, you're going to get a really good return for not necessarily outsized risk. So 8 to 15% is achievable without putting the house at risk in this market. So then you look at these debt secondary funds that have turned up. They offer similar returns. It's 8 to 15 depending on the fund. You've got FX risk when the Aussie dollar is the weakest it's ever been. So even if they shoot the lights out, you've got a capital loss when the money comes back, number one. Number two, they're lending into the US LBO market. EU and the US LBO market. So that debt's at 5 to 7 times EBITDA. That's junk bond territory. 8 to 15% doesn't seem that attractive then. And the third point is, why a debt secondary fund? So if you look at equities are a long-term investment. The market conditions aren't right, you can't get out. So a PE or VC fund will go, look, I need a secondary fund as an escape valve. But with debt's got a finite term. You write a loan for 1, 2, 3 years. So if I've got to roll over a loan into a secondaries fund, that means I can't get my money back at the end of 2 to 3 years. So that loan's already challenged. So you put all of that together and you go for 8 to 15%, you really should be in a domestic fund.
Patrick, thanks for joining us.
Thanks for having me, Tom.
Thanks for tuning in. Make sure to check out our YouTube channel for more great videos.